Every second of every trading day, billions of dollars move through global financial markets. But here's what most people don't realize: humans are not making these decisions. Instead, sophisticated artificial intelligence systems are executing trades, analyzing patterns, and predicting price movements with precision that seems almost supernatural. In 2024, algorithmic trading controlled between 60 to 80% of all equity trades in major markets. This isn't speculation anymore. This is the reality of modern finance. The question isn't whether artificial intelligence controls markets. The question is, how much control do these systems actually have? And what does this mean for investors like you? The invisible infrastructure of financial markets. Most traders never see the algorithms working behind the scenes. Financial institutions employ vast networks of artificial intelligence that process market data at speeds exceeding human comprehension. A single trading firm might execute anywhere from 150,000 to 300,000 trades per day. These trades happen in milliseconds, capitalizing on tiny statistical advantages that humans could never detect manually. Firms like Goldman Sachs, JP Morgan Chase, and BlackRock have invested billions into developing proprietary AI systems. BlackRock alone allocated $17 billion to technology in 2023, with plans expanding to 1,000 different AI use cases by 2025. JP Morgan announced an $18 billion technology budget for 2025, with over $3 billion dedicated specifically to artificial intelligence advancement. These aren't passive investments. They're active bets on controlling the future of financial markets. These AI systems don't simply trade faster than humans. They think differently. Deep neural networks analyze historical price movements, identify patterns, and construct trading strategies based on complex mathematical relationships that would take human traders decades to understand. Long, short-term memory networks, or LSTM systems, can predict currency movements with 82% accuracy by analyzing years of trading data. Convolutional neural networks, traditionally used in image recognition, now detect market anomalies that signal profitable opportunities. The sophistication doesn't stop there. Sentiment analysis systems scan millions of news articles, social media posts, and financial reports in real time. Goldman Sachs uses such tools to measure market emotion and psychology, translating human behavior into actionable trading signals. One particular system, called MarketSight, quantifies emotions and themes from financial news, generating sentiment scores that predict price changes before they happen. This gives institutions wielding these tools an almost unfair advantage. They can anticipate market movements before ordinary investors even know a story broke. The legends who started it all, the clearest example of AI domination, came from an unexpected source. A mathematician named Jim Simons founded Renaissance Technologies in 1982, but not with the goal of becoming a trading firm. Simons worked as a codebreaker for the NSA. He understood patterns and mathematical structures. When Simons entered finance, he brought this mentality with him. He refused to hire traditional Wall Street bankers. Instead, he recruited physicists, mathematicians, and computer scientists. These brilliant minds built the Medallion Fund, and what happened next shocked the financial world. From 1988 to 2018, the Medallion Fund averaged 66% annual returns before fees. After fees, investors saw 39% annual gains. No hedge fund manager in history came close. Warren Buffett, George Soros, and Peter Lynch all fall short. The entire fund would generate more than $100 billion in trading profits over its 3-decade history. Simons famously said, "I want models that will make money while I sleep, a pure system without humans interfering." That quote encapsulates the entire philosophy of algorithmic trading. Remove human emotion, remove human judgment, and let mathematics speak. Renaissance executed this vision with ruthless efficiency. Their algorithms would trade currency futures, interest rate swaps, and stock indices, exploiting tiny statistical edges that appeared across milliseconds. Simons' success didn't create competition. It created a revolution. Today, nearly every major financial institution operates on the principles Simons perfected decades ago. The modern AI trading ecosystem, fast forward to 2025, and the landscape has transformed completely. The AI trading market itself was valued between $13 and $15 billion at the start of 2025. Forecast project expansion to between $33 and $70 billion by 2030. This explosive growth indicates that artificial intelligence isn't just supplementing human traders. It's replacing them entirely. The broader algorithmic trading sector, infused with artificial intelligence capabilities, reached approximately $18 to $23 billion in 2025. These numbers don't capture the entire AI in finance ecosystem. When including enabling infrastructure, analytics platforms, and enterprise applications, the global AI and finance market is projected to reach $190 billion by 2030. This exponential expansion reflects a fundamental shift in how capital flows through the global economy. Consider what JP Morgan accomplished. The bank deployed over 200 AI use cases across operations. Automated KYC, or Know Your Customer verification, eliminated hours of manual compliance work. Trade surveillance systems now monitor millions of transactions, flagging suspicious patterns that human eyes would miss. These initiatives saved the bank over $5 billion in operational costs while simultaneously improving compliance and risk management. Beyond cost savings, JP Morgan's systems directly enhance trading performance through predictive analytics that assess market movements and volatility across diverse asset classes. Goldman Sachs took a different approach. The firm deployed its GSAI assistant to nearly 4,600 employees. This generative AI tool helps bankers draft pitch materials, analyze data, and summarize complex documents. On the trading desk specifically, Goldman's AI systems incorporate structured and unstructured data, including social media feeds and newswire services. The system executes trades autonomously, but human traders still monitor dashboards for unusual patterns, ready to intervene. This hybrid model represents the future artificial intelligence as a cognitive multiplier, amplifying human decision-making rather than replacing it entirely. Yet, despite the oversight, these systems operate with an autonomy that would have seemed impossible just 5 years ago. Alternative data sources are revolutionizing prediction capabilities. Two Sigma and Citadel use satellite imagery to track industries, including energy, agriculture, and retail. They monitor shipping patterns, manufacturing output, and inventory levels from above, spotting trends before anyone else. Social media analysis proves remarkably accurate. Sentiment analysis on platforms like X, formerly Twitter, can predict market movements with 87% accuracy up to 6 days in advance. Some firms track corporate jet movements. When a CEO boards a private plane for an unexpected trip, it signals a major announcement approaching. This information asymmetry creates massive trading advantages. The alternative data market is expected to grow at 50% annually through 2030. This acceleration means institutional investors will only increase their informational edge over retail participants. The consolidation of power, one critical consequence of AI dominance, deserves attention. Data oligopolies are forming. Firms with superior access to proprietary data build more effective AI models. These firms consistently outperform competitors, attract more capital, and reinvest in exclusive data sources and advanced AI systems. This creates a self-reinforcing cycle of dominance that grows stronger year after year. A smaller number of mega institutions now control an increasingly large percentage of global financial trading. This concentration of power raises legitimate questions about market stability. When algorithmic systems become highly correlated, when firms employ nearly identical AI models, systemic fragility increases. The 2012 Knight Capital Group incident provides a warning. A single software glitch generated millions of erroneous orders. The firm lost $440 million in 45 minutes. Imagine if multiple large firms experience simultaneous algorithmic failures. Regulators now monitor this risk closely. Circuit breakers exist to pause trading during extreme volatility. Position limits restrict the size of bets. But critics argue these safeguards may not be sufficient as artificial intelligence becomes more sophisticated and more deeply embedded into trading systems. Some economists worry about algorithmic herding. When many systems respond to identical market conditions in identical ways, they can amplify price movements rather than stabilize them. During the 2020 market crash, the relationship between price movements and traditional risk factors broke down. Some researchers attributed this partly to simultaneous algorithmic selling across multiple asset classes. Yet despite these risks, institutions continue deploying more AI. The incentive structures simply favor speed, accuracy, and automation. A trader using AI can monitor 10,000 charts per second. A human trader can realistically follow maybe 10. The advantage is too massive to ignore. The future of finance belongs to machines. As we look ahead, one trend becomes undeniable. Artificial intelligence will continue consolidating control over financial markets. Firms like BlackRock and JP Morgan aren't simply optimizing existing processes. They're building entirely new infrastructure for the AI economy. BlackRock launched the AI infrastructure partnership with Microsoft and technology leaders including NVIDIA and Elon Musk's xAI. The stated goal involves unlocking initial capital of $30 billion to construct next-generation AI data centers. This isn't about trading a few more stocks per second. This is about controlling the very computational foundation of global finance. The implications extend beyond profit margins. Markets derive their efficiency and stability partly from human disagreement and interpretation diversity. When algorithmic systems enforce uniform logic across billions of transactions, interpretive diversity narrows. This represents both opportunity and danger. For investors who understand these systems, the opportunity is enormous. For those caught unprepared, the risks are equally substantial. The hidden AI systems controlling modern financial markets are no longer hidden. They're visible, measurable, and increasingly dominant. Understanding them isn't optional anymore. It's essential.